Brent Johnson, who runs Santiago Capital out of San Francisco, invented a theory that he calls the dollar milkshake theory. It's basically about how the US dollar is going to go up a lot over time against other currencies. Brent Johnson believes that the dollar index, the DXY, is going to go above 130 at some point in the near future. The dollar milkshake theory is gaining traction among investors very quickly. However, recently, Peter Schiff, chief economist of Europacific Capital, refuted this theory on one of his podcasts and pointed out why the scenario that Brent Johnson and many other dollar bulls are betting on will likely not happen. Let's hear from Peter Schiff.
But he articulates his own theory, but I think he's missing some big flaws in that theory. But when he talks about, hey, there's all this dollar-denominated debt in the world, right? And what if the borrowers, need those dollars, or they do need the dollars, right? They need the dollars to make interest payments, and then they need the dollars to pay off the principal when the loan is due. And somehow he thinks that this means there's this huge demand out there for dollars. And in fact, there could be the equivalent of a global short squeeze, as everybody who owes dollars is rushing to get those dollars. But the problem is, when you look at it from one side, right, the borrower, you forget about looking at it from the lender's perspective, right? The person who has loaned out dollars and is expecting to get repaid, right? Because not everybody who is going to get repaid dollars wants those dollars. A lot of people sell the dollars as soon as they get them.
Brent Johnson believes that there is a huge demand for US dollar globally because a lot of entities outside the US have borrowed money in dollars and now they need to accumulate dollars in order to service the debt. However, Peter points out that Brent's logic is flawed because he is not looking at the full picture. He is only looking at the issue from the borrower's side and not from the lender's side. Let's go back to Peter for more clarification on this.
Right? The person who has loaned out dollars and is expecting to get repaid, right? Because not everybody who is going to get repaid dollars wants those dollars. A lot of people sell the dollars as soon as they get them, right? What if I am a guy and I live in Thailand and I loan money to a business in Indonesia, but we don't want to make the loans in the baht or the rupee. So we agree to do the loans in the US dollar, right? To have a stable currency that we both trust, right? So the guy in Indonesia owes the guy in Thailand dollars. But when the loan is repaid or when the interest is repaid, does the guy in Thailand, does he keep the dollars? No, he turns around and sells them, most likely as soon as he gets them. I mean, if he's getting his interest payments and then he needs them to pay his rent or to pay other local bills, he doesn't pay those bills in dollars. Even though the bond is denominated in dollars, when he gets the dollars, he turns them into his local currency. So even though you have the Indonesian company having to buy dollars to repay the loan, as soon as the loan is repaid, the dollars are turned around and sold. So you get plenty of people selling dollars because of dollar loans as buying.
So Peter is saying that many lenders issue debt in dollars for one reason or another, but once they get paid back, they do not hold on to these dollars. They just sell them in the market for the local currency. Thus, the supply of dollars on the market is constantly being replenished to meet the demand.
Of course, they have to overlook the trade deficit, right? The trade deficit automatically means that there's an extra $500 billion on the global market every year, right? That nobody needs, right? Because that's the deficit. We buy goods and then we pay for them by exporting paper. I mean, we pay for some of the goods with our own goods. We export goods and services, but there's a big gap. And the difference is over $500 billion a year. So now the world's got $500 billion a year that it's not using to buy goods and services in America. So what is it going to do? It's either going to sell those dollars on the market or it can invest those dollars in U.S. financial assets.
Peter points out a very important issue here that is being overlooked by many dollar bulls, and that is the fact that the US trade deficit is constantly providing an increasing supply of dollars on the market year after year, and in the long term this will put downward pressure on the dollar. But then guys like Brent Johnson might say that this downward pressure is actually being counteracted by the demand for dollars from foreign investors who seek to invest in US stocks and bonds. Here is Peter's response to that.
People receiving those dollar payments are likely to turn around and sell them to get other currencies. Now, one of the reasons that they may not sell them is maybe they want to invest them. Maybe they want to take the dollars that they earned and make another dollar denominated loan, or maybe they want to take those dollars and buy US stocks or US bonds or something like that, right? So maybe they'll stay in the dollar. But what if they don't want to do that? What if when the loan is repaid, they decide they don't want to make another dollar loan, or they don't want to buy a US stock? Maybe they want to buy a local stock, which to them would be a foreign stock to us. Maybe they think the US stock market is too expensive. Maybe they think the US bond market is too expensive, which they are, right? Maybe U.S. financial assets are going to lose their appeal. And so a lot of dollar-denominated debt, as it matures, the lender is now going to be dumping those dollars to get a different currency so that he can invest in assets in another country that have better valuations. See, I think that is the key that all the dollar bulls are missing. Is this going to be this massive glut of dollars with no demand?
Peter's saying that US assets are currently trading at very rich valuations when compared to foreign assets. And if US stocks and bonds keep rising, at some point foreign investors will prefer to invest in assets outside the US because they make more sense from a risk-reward perspective. Thus, foreign investors' demand for US dollar cannot be relied upon in the long run to counteract the increase in the supply of dollar.
Meanwhile, the supply of dollars is going to increase dramatically, not just from our trade deficits, but from our budget deficits. I already mentioned on this podcast, but right now about 55 cents out of every dollar the federal government is spending is being printed by the Federal Reserve. Most of the government is being financed with newly printed money. So the supply of dollars is growing dramatically. Well, what does that mean about price? Price has to come down. This is basic supply and demand. It doesn't matter about all these dollar-denominated loans.
So Peter does not forget to mention that the Federal Reserve is constantly increasing the supply of dollar through money printing to finance the budget deficit. And over the long run, this will devalue the dollar.
And he's also focusing on all the dollar debt, right? Especially when we just had this big collapse with a big recession related to COVID. The idea was, now a lot of these companies around the world in the emerging markets that have borrowed in dollars, they're not going to be able to service their debts. They're not going to be able to repay their debts because their revenues are down. It's a recession. And so now there's going to be a mad scramble for dollars, and you're going to have this surge in the dollar. Except it really didn't happen. I mean, yes, the dollar went up. In the middle of all the chaos in March of 2020, the dollar did rally all the way up to just under 103. That's it. That is the highest the dollar index could go as stocks were imploding all over the world and we were engulfed in a pandemic, right? The biggest panic I've ever seen, right? The quickest and sharpest decline in global equity prices. And all the dollar index could do was rise to 102.9. It did not even get back to its 2017 peak. It didn't even get as high as its 2015 peak. So you had this double top in the dollar with the highs of 2015 and 2017. And despite all the pandemonium, all the panic, this strong dollar could not even take out that resistance. That tells you that the dollar is not nearly as strong as people think it is. Because if it couldn't take out those peaks, given all that was happening in March, why would it do it later?
Okay, something that needs to be mentioned here is that when the US dollar rallies too high, it makes every other asset go down. So the US stock market crashes, global stock markets crash, commodity prices crash. So it causes a lot of problems, and the Federal Reserve knows this, and there is no way that they will allow it to happen. The Fed can actually control the level of the US dollar to a large extent. We saw that in the middle of March. Back then, when the dollar started to rally and stocks, bonds, and commodities crashed all over the world, the Fed came to the rescue and started flooding the world with dollars and successfully prevented the dollar from going higher. The dollar index peaked back then at 103 and it's been declining ever since. So with the Fed more determined than ever to support the stock market, it's very unlikely that the dollar will be allowed to rally as high as Brent Johnson thinks.